All right, today we're going to pull back the curtain and decode the fundamental language of trading. Have you ever glanced at a trading platform and just felt completely lost? Like you're trying to read a different language? If so, trust me, you are definitely not alone. It can feel like this insane wall of flashing numbers and terms that's just really overwhelming. But what if we can make it all make sense? That's what we're going to do. We are going to follow the path of a single trade step by step. And by the time we're done, you won't just understand what those numbers mean, you'll actually see how they all connect. Okay, first things first, let's talk about price. Here's a little secret. Every asset you can trade doesn't have one price, it actually has two. And understanding this difference is the absolute first key to unlocking the market. This whole concept is called the bid ask spread. It's simply the gap between what buyers are bidding for an asset and what sellers are asking for it. And this little gap is the starting point for every single transaction. Let's break this down to make it really easy. Just think B for bid, B for buyer. The bid is the highest price someone out there is ready to pay right now. And the ask, well, that's the lowest price a seller is willing to accept instantly. These two numbers represent the best possible prices for an immediate trade. A great way to think about this is to imagine selling a house. When you sell a house, you set an asking price. Then buyers come in and make their bids. It's the exact same principle in the financial markets, it just happens at lightning speed. So we have two prices, but often the most important information is actually the space between them. That gap, which we call the spread, tells you a surprising amount about the market you're looking at. Just look at this comparison. On the left, we've got a narrow spread of just 1 cent. This means buyers and sellers are really close to agreeing on a price. But on the right, you see a wide spread, 25 cents. Here, the buyers and sellers are much, much further apart. So, what is that gap really telling us? Well, a narrow spread usually signals a liquid market. That means lots of active traders, which makes it easy to buy or sell. A wide spread, on the other hand, suggests an illiquid market with fewer people trading. That means it has a higher cost to get into a trade and a bigger risk of something called slippage, which is when the price you click isn't quite the price you get. Now, here's the crucial point. If you buy at the higher ask price, the market has to move up past that price just for you to break even. With a narrow spread, that's a tiny little hurdle, but with a wide spread, it's a huge one. And that's exactly why traders always hunt for tight, narrow spreads. Okay, so you understand the price. Awesome. The next question is, how much are you actually trading? And that is where the concept of lots comes in. A lot is simply the standard unit size of your trade. So instead of saying you're trading, 100,000 euros, you just say you're trading one standard lot. It's the universal language for trade size. And the great thing is, you have options. A standard lot is 100,000 units, but for anyone starting out, or maybe just using different strategies, there are smaller sizes. You've got the mini lot at 10,000, the micro lot at 1,000, and even a nano lot at just 10 units. This whole system gives you flexibility and lets you manage your risk very precisely. So, we've got our price and we've got our size. Now, how do we measure our profit or loss? We don't really talk in dollars and cents, we talk in pips. A pip, which, by the way, stands for percentage in point, is the smallest standardized move a currency price can make. Just think of it as one little point of movement. It's the fundamental unit we use for tracking a trade's performance. So, where do you find it? For most of the major currency pairs, the pip is the fourth number after the decimal point. So, if a price moves from 1.1028 to 1.1029, that's a 1 pip move. Simple, right? The only major exception is with the Japanese yen, where the pip is actually the second decimal place. Now, just so you're fully prepared, you might sometimes see a fifth decimal place. That tiny extra digit has a name. It's called a pipette, or a fractional pip. It's just 1/10 of a regular pip, and it allows brokers to offer even more precise quotes. Okay, we've covered a lot. We've talked price, size, and measurement. Now let's put all these tools together and quickly review the journey of our trade. See, it's a pretty logical flow. First, you look at the two-sided price, the bid and the ask. Second, you check that gap between them, the spread, to understand the market's liquidity. Third, you decide on how big your trade will be using lots. And finally, once you're in, you track its progress, move by move, in pips. And there you have it: bid, ask, spread, lot, and pip. These aren't just confusing jargon anymore, are they? They are the essential tools you need to read the market, understand your risk, and follow any trade from beginning to end. So that blur of numbers we started with, it now has meaning. You have the basic tools to decode the market. So, I guess the only question left is, now that you speak the language, what's your first move going to be?